of people are interested in Medicaid planning, and some of you may have even heard about using immediate annuities with Medicaid planning. And here to talk with me about that is Harry Margolis. He's the author of Get Your Ducks in a Row. Harry, welcome.
Good to see you again, Bob.
Likewise. So this is an interesting topic because I get lots of questions, as I'm sure you do, about Medicaid annuities. Tell us what we need to know, the pros and cons, when to use them, when not to use them.
So let me set the stage a little bit. So Medicaid pays for nursing home care, unlike Medicare, but also unlike Medicare. To get Medicaid coverage, you have to be impoverished under their rules. And for most places in the country, being impoverished means you only have $2,000 in countable assets. But your spouse also has to spend down their assets, and they're only allowed to have about $150,000 in countable assets. That number goes up every year with inflation. They can also keep their home. And in some cases, the states differ on this. They may be able to keep their retirement plans separate from that. So if they have more than $150,000, in theory, they're supposed to spend all of that down before you say you're in the nursing home and your spouse is at home. The spouse has to spend down $150,000 before Medicaid will begin covering your care. But one planning technique can help preserve their financial stability, and that's the immediate annuity. So you can't give away assets. You're not allowed to give away assets and say, now I'm down to $150,000. There's a 5-year penalty for that. So if you do that, you're ineligible for benefits, and your spouse is ineligible for benefits for the following 5 years. But there's no restriction on buying assets. And so if you buy an immediate annuity, which is an investment product that meets certain requirements, there's no penalty for that. And in fact, what you're doing, I should probably go back and also from setting the stage, explain what an immediate annuity is. An immediate annuity is a contract with an insurance company where you give them money and they promise to pay you income for a period of time. Often it's for your whole life. So it's like a private pension. So the spouse of a nursing home resident may take their excess assets over $150,000 and purchase an annuity that basically pays them back the money over time. And that way they have an income stream and they stay financially solvent, and Medicaid begins to pick up the cost of your nursing home.
Right. So you mentioned that the spouse would do this. Would the person, the recipient of Medicaid, also be in a position to take some of their assets long before they think that they might qualify or need to qualify for Medicaid, and also create a immediate annuity to
that gets more complicated, and it makes some sense in some states because Medicaid is a joint federal state program. It's run by the states, but the federal government sets the ground rules, and they reimburse the states, depending on the states, say 50 cents on the dollar for whatever the states spends on Medicaid. So the state programs differ a bit. And so going back to what I said earlier, that the nursing home resident has to spend down to $2,000. Now, if you're married, it always makes sense only for the healthy spouse to buy the annuity. But if you're single, it may make sense in some states and some circumstances for a nursing home resident to do it. So what they're doing is they're taking their excess assets over $2,000 and they're turning it into an income stream. And the income they're getting actually goes to the nursing home, because when you're getting Medicaid, you have to pay your income to the nursing home. Medicaid just picks up the balance of the monthly costs. So the reason you still might do an annuity is because you can buy an annuity that will pay for a guaranteed period of time. So say you buy an annuity that will pay for 10 years and you pass away before the end of the 10 years, the payments will continue, to whoever you name as your beneficiary. So the reason for a single person to buy annuity is for that remainder payment after they die to go to their loved ones or whoever they want to benefit. There are also restrictions there on repaying Medicaid for its expenses. So it gets complicated. And to be honest, we never do that in our practice. We never do immediate annuities for single individuals. But I do know that some people do that in some states. But we do use them a lot for spouses.
Yeah. When you think about using them with spouses, are there any timing considerations or potential penalties if they're purchased, say, within the 5-year look-back period, or does that only pertain to the
No,
person who is in the nursing home?
right. So there's no. If you follow the rules, you don't have to worry about the 5-year look back. So you can do it at any time. But part of the rules have to do with the life expectancy of the healthy spouse, who they call a community spouse. So remember, we were talking about you can get something that pays for life, but you can also get this term certain. And so what you cannot buy an annuity that has a term certain that's longer than the actuarial life expectancy of the healthy spouse. So if the healthy spouse is up in years, say they're 90 years old, their actuarial life expectancy is going to be pretty short. So you can't buy a long-term certain in that case. It has to be pretty short. But if you work with an elder law attorney or a annuity salesperson who knows these rules, then you'll make sure you follow them correctly.
Harry, at the beginning of our conversation, you mentioned countable assets, and I think
Right.
sometimes people don't have a good grasp of what's countable and what's not. People wonder, is my IRA a countable asset or not,
Mm-hmm.
or is et cetera. So maybe walk us through that.
Yeah. So the starting point is everything's countable. So your IRA, your 401k, your investments, your savings account, just about everything. The one item that's not countable, the principal item, is your home. So your home is not countable. And if you're a married couple and one of the spouses still living at home, there's no issue, and there's actually no limit on the value of the home. If you are if you're a single person and in a nursing home, you can actually still keep your home and get Medicaid benefits. There's an equity limit. It differs a bit from state to state, but the equity value of the house cannot exceed $1 million in most states. So and that covers most people, but in some high rent states, there are a lot of houses that are worth more than $1 million. So it can be a problem. Um, so that's the main non-countable asset. You're also allowed to keep a car. You can prepay your funeral. So prepaid funeral plan is not countable. And as I said earlier, depending on your state, you may or may not be able to keep a retirement account. And that's where the states differ considerably.
Yeah. It's interesting because obviously with retirement accounts or any account really, right, there are taxes to be paid on distributions, and
Right, right.
that could be perhaps something that people aren't taking into account when they think about having to draw down their retirement accounts to pay for
Right.
nursing home care.
Yeah. So, and sometimes it kind of works out because you draw it down to pay for home health expenses or pay the nursing home, and that's a deductible expense. Um, but often what happens is the nursing home spouse has to spend down to $2,000, and we want to transfer their assets over to the community spouse because they can keep 150,000 and can annuitize the excess over that. But if the nursing home spouse has a big retirement plan, then you have to liquidate and pay the taxes on it in order to move it over, and that's unfortunate.
Harry, we've covered a lot of ground. Anything we missed?
No, it can get complicated is the problem. But so in specific situations, it really does make sense to consult with with an elder law attorney, and I'd say a local elder law attorney, because each state, as I said, has its own program and their own practices, and you really need to know what works in your state. I hope so. I hope we didn't just confuse them.